Now to dive deeper, Art Hogan, Chief Market Strategist for B. Riley Wealth Management, joins me. Art, it's always a pleasure and great to get your insight on a very important week here on Wall Street. With all eyes on that Fed decision on Wednesday, what are you expecting?
Yeah, so I think that the what's interesting here is the market is actually probably ahead of the Fed in terms of how far they actually go. So we've been basically at a coin toss for most of the last couple of weeks, and that's starting to edge into a bit of a consensus that they go 50 basis points. Now, what I think they should do is go 50 basis points. What I think they will likely do is go 25 basis points. And I think this is a Fed that has liked to start out a bit slow when they shift directions. When they started raising rates, they went 25 basis points, even though inflation was north of 9% on the CPI. And then they started picking up the pace. I don't know that it matters one way or the other if they go 25 or 50 today. I think what really matters is what they tell us in their summary of economic projections about the destination. How many times are they going to cut, and where do they see the neutral rate? We'll get more information. So I think you can really tell a tale about the destination and how far we're going versus the first step that we took along that path. So I'd rather see them go 50 basis points, but I think either is okay for today. But the summary of economic projections telling us that we're likely going to see 100 basis points this year and at least 125 or 150 basis points next year is much more important than what they actually do today at 2 o'clock or tomorrow at 2 o'clock.
Art, I lost a bit of your audio there. I hope our viewers can hear you loud and clear. It just kind of trailed out at the end, but I'm sure we'll get it situated here. For our viewers watching at home, I hope that wasn't the case for you. But Art, circling back to this rate cut and how important it is, we did get August retail sales data out earlier this morning. How does that factor into the Fed's decision?
Well, the good news is it was better than expected at the headline and very much in line with expectations throughout the rest of the detail. That it has slowed a bit on a month-over-month basis, but it certainly continues to show that the consumer continues to be aggressive and out there, but actually seeking out more value. So over the last couple of months, when you look at the breakdown in the internals, you're certainly seeing investors that are favoring things like Costco, Walmart, and TJX. But I think that's a very healthy thing. So the consumer is very important to the U.S. economy, nearly 2/3 of our GDP. I think today's report doesn't change what the Fed does necessarily, but certainly reinvigorates the fact that they're still inside that zone of a potential soft landing.
So, of course, those retail sales data coming in better than expected, Art, and we could potentially see some volatility in the market after that Fed decision. Do you think the Fed is behind the curve? That's such a common question asked, especially as we debate whether it's a 1/4 percentage point cut or 1/2 of a percentage point.
Yeah, there's actually people that on the Fed that were voters that said they were willing to go in July. I think once we started to see the softening of the labor market, that was the clear signal that the Fed needed to shift their focus to their other mandate, which is full employment. They took a pass in July, which is why I think they should go 50 basis points now. Just to put that in perspective, we've gone from creating about 170,000 jobs on a 3-month run rate basis to 116,000 jobs. While that's still inside that window of acceptability to keep things status quo and keep employment full, which is anywhere between 100 and 150,000 jobs, it's certainly getting closer to the lower end of that. So, behind the curve, should the Fed have cut in July? I don't think they felt like they prepared the markets enough to do that, but I think had they done that, there would be no question about the fact that they could go 25 basis points July, this meeting, November and December. So I think a little bit of a catch up or front end loading this would probably help them get back, into the right place. And whether that happens now or one of the next 2 meetings, I think it's going to be important to get 100 basis points under their belt before the end of the calendar year.
So it's interesting, Art, because I know you mentioned the destination is important here, what we hear from the Fed in terms of planning for future rate cuts and perhaps what that ultimate end is for rate cuts in the economic cycle. We spoke about retail sales data out earlier today. What else is the economic data telling you about the state of the consumer and the health of the overall economy?
Yeah, such a great question. So the good news, I think, is that while the labor market is softening or normalizing. I think you also have a consumer that continues to spend, but in a way that is much more value focused. And traditionally, this has been the American consumer's way for decades now. So whether we look at Amazon or a couple of the new Chinese offerings and Temu and Shein, or you look at companies like Costco and TJX and Walmart, that has been the dominant player out there, to the detriment of some of the dollar stores. Now, I would offer up that if we have finally gotten to the point where wages are going up more than the rate of inflation, the consumer's doing okay, still feeling the pinch of higher prices, but doing okay. If you look at GDP growth rates this year, last quarter was 3%, this quarter is at a 2.5% run rate. So GDP is running up ahead of its potential, which is another positive. And earnings for the S&P 500 look like they're going to be sequentially better both in the third and fourth quarter. So to the extent that the market is in okay shape, it's time for the Fed to start normalizing and becoming less restrictive. And I think we'll learn a whole lot more about that Wednesday afternoon, both in the summary of economic projections, in the press conference, and certainly in their statement, where we're going to see multiple changes. I think the consumer's in okay shape, but we certainly don't want to see much more degradation to this labor market. And Jay Powell talked about that at his speech at Jackson Hole.
Do you think the so-called soft landing is still possible, Art?
100%. We're right in the sweet spot for that, right? So we got GDP growth that is normalizing down from 3.5% in the back half of last year to close to 2.5% this year. So that's normal and sustainable. We've got unemployment that's come up from 3.6% to 4.2%, certainly sustainable, right? And to the extent that a soft landing actually means that, you need to see inflation come down, you need to see the labor market loosen up a little bit. The problem is normalizing and then going too far and then getting into where we're in an economic slowdown is a very fine line, and that's why monetary policy needs to step in and certainly keep track of all of the moving parts and get us to the right place. But yeah, I think the soft landing course is still on path, and it's just a function of the Fed nailing the landing and not dragging their feet too much and getting to that neutral rate sometime next year.
Certainly, as we head into the fall, Art, after the first debate between former President Trump and VP Kamala Harris last week, I think a lot of people are asking the question, does politics play into the economy? What might the election mean for the overall economy and for stocks? What's your response?
Yeah, that seems to be everybody's question right now. And what's interesting is it's always about, when we're in a presidential election year, it's, his policies versus her policies, and what does that mean for economic growth? And we kind of have to take a step back and remember that what you say on the campaign trail is very difficult to put into practice unless and until you have control of Congress. And all of the polling look like that's not going to be the eventual outcome. So to the extent you can say a whole lot of things about tariffs or cutting taxes or raising taxes and different kind of fiscal policy programs, but you have to get that all passed through Congress. I think that the likely event is agnostic of who's in the White House. Congress is going to be divided, and I think that's something the market can celebrate and likely won't cause any major shocks to the market.
In terms of what we hear about the destination on rates, how do you see that playing out in terms of how many cuts we might get, and if what matters to the Fed changes? In the latest meeting, of course, in July, we had heard that finally, after 2 years of inflation being in focus, it really was a dual mandate matter, and jobs data matters too.
Right, I would say the jobs data finally matters more than inflation data. I think inflation was last year's problem. I think we're getting close, and the glide path to their target is certainly on track. So they do not want to see the softening jobs market continue to soften. That's why the focus now is on their second mandate, which is full employment. And I clearly believe the path to getting to that is to cut rates by at least 100 basis points this year, and then probably by 150 basis points next year. And it really doesn't matter what the increments are to get there, it's the destination. We need to get the Fed funds rate down to what is likely the neutral point, and that probably sits somewhere between 2.75% and 3%. So that means we've got 200, 250 basis points of cuts coming, and hopefully they happen over a shorter period than 2 years. We'll see a lot more about that, or where the FOMC is thinking about that, when we get that summary of economic projections, which includes that dot plot. And we'll likely see what they're thinking right now about how much they're going to need to cut over the course of the next 18 months.
Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, always a pleasure. Thank you so much.
Great to see you.